Hello guys, it's Samuel here. I know everyone says when they are down on a stock or option trade, they're going to hold until break even. But I have to say this is not a good strategy in the long run and is known as the break-even fallacy. What is the break-even fallacy? When stock or option positions are down, investors and traders say, I'll wait and sell when the stock comes back to the price I originally bought for. That way, at least I'll break even. This is not a good plan. First of all, there's absolutely no guarantee that a stock will ever come back. And with options, there's even more uncertainty. Second of all, waiting till break even, the point at which profits equal losses, can greatly erode your returns. The temptation is understandable to be made whole, but cutting your losses can be more important. To demonstrate, this chart shows the amount a portfolio or security must rise after a drop to get to the break-even point. While most think after going down 50%, you must go up 50% to break even, this is not the case. A stock or contract that declines 50% must increase 100% to break even. Think about it in dollar terms. If a stock drops 50% from $100 to $50, it must rise $50 or 100% to return to the original price of $100. Further, larger losses require much larger returns to break even. This isn't to say that rebounds never happen. Sometimes a stock has been unfairly plummeted, but the long turnaround waiting also means the stock is tying up capital that could be put to work in different stocks with better potential. The drawdown idea is also important to note for options trading and important for minimizing drawdown by balancing your portfolio, so you don't have to require ambitious returns to break even after an initial loss. Always think in terms of future potential. You often hear that the best offense is a good defense. This is true in sports and can be applied to the stock market as well. You need a predetermined defense strategy to prevent excessive losses. It is important to have a predetermined stopping point, as before you enter the position, you can think most clearly about when and why you would want to sell. You have no emotional attachment before you buy anything, so a rational decision is far more likely. Once we own something, we tend to let emotions such as greed and fear take over and get in the way of good judgment. A selling strategy that's successful for one person might not work for someone else. In the next video, I will cover where to set a stop loss and the common practices to avoid. There are 3 questions to ask before selling. First, why did you buy the stock or contract in the first place? Before entering an investment or trade, you should have a thesis or underlying assumption that can be proven true or false. This will allow you to identify when to exit as well as ensure a clear reason prior to entry. Next, what changed? If a stock or contract value has gone down in price, there's usually a reason for it. Is this identifiable, and does it disprove your original trade thesis? It is important to not limit your research to only the original purchase reasons. Review all the latest headlines related to the firm, review all of the latest SEC filings for any events that could have potentially diminished the returns behind the investment. If after some research you see the same qualities as before, holding is appropriate. Last, does the change impact the trade thesis? If you have determined that there has been a change, identify if the change is material enough that you would not enter the trade again. If so, it is better for you to offload the position. This approach requires you to know something about your investment style. To make intelligent selling decisions, remembering not to get emotionally attached to a position is critical. One pronounced cognitive bias in trading is loss aversion. Many of us just can't handle seeing our funds or other investments in the red. The need to not be wrong is the reason most lose money. Once we own something, we tend to let emotions such as fear and greed get in the way of good judgment. You don't want to make trading decisions based on where you bought or sold a stock, as the market doesn't care where you entered. The question to ask is what you would do if you were not in the trade. It's important to think critically about selling. Know your investing style and use the strategy to stay disciplined. Keep keeping your emotions out of the market. All investors are different, so there's no hard and fast selling rule which all should follow. Even with these differences, it is vital to have some type of exit strategy. The points here are to think critically about selling, know what your investment style is, and then use that strategy to stay disciplined, keeping your emotions out of the market. I hope you enjoyed this video on the break-even fallacy. Comment below your thoughts, and if you liked the content, make sure to like and subscribe below. Thanks, everyone.